that ISM manufacturing number was arguably what provided the real downside draft to markets. How important is the services read going to be when it comes to trying to either counter or exacerbate the moves that we've seen?
Well, much more important because, as you stated, it makes up a much bigger part of the U.S. economy. But we can't separate the two because a lot of services businesses have manufacturers as clients.
In what way? I mean, is that the reason why we focus so much on those transportation stocks?
So the transportation companies, the trucking companies, the rails are considered services, but they're shipping all the goods that the manufacturers are making. Or take a restaurant that happens to have a location near a manufacturing facility. If there are less people working at the manufacturing facility, there are less people going out to the restaurants. So there is a connection, and yes, manufacturing is only about 10% of growth, but it also reflects a general slowdown that services side of the economy is not going to be immune from.
Has that services side of the economy recently, over the course of the past, say, year, shown signs that we are due for a recession anytime soon?
Well, if you look at the ISM measure and you look at market, their services indices have been moderating. Not to the same extent as manufacturing, but there has been a crossover in the sense that manufacturing is now beginning to affect the services side. Now, services generally over the past year, not just in the U.S., but in Asia and also Europe, has held in much better. You know, you even look at Germany. Germany's economy is basically flatlining for 2 quarters, but their unemployment rate is the lowest since reunification, and the consumer is actually still hanging in there. But you wonder, for how long can this be? When you take manufacturing, well, they're beginning to cut hours. They're beginning to cut workers. Well, these people are then going to spend less money at retail and restaurants, as I mentioned, and other services. So there are intertwined, and again, the services side's not going to be immune.
There was a lot of commentary, a lot of dissection of that PMI manufacturing number, right? This idea that you could see, you know, certain parts subsector-wise within that report show even dire circumstances ahead, even more dire than what we saw with the headline number. Are there places within ISM non-manufacturing and services that you will be dissecting into to see whether or not there is any validation for the current sentiment that we're seeing?
Well, to your point, the biggest obvious weakness in manufacturing was the export number, where exports got down to like 41, and with 50 being the break even. Now, on the services side, they'll report an export number, but only some service companies have exports. So it's a much smaller component. But I'll still be watching the export component and also new orders and backlogs, because that is a leading indicator of what's to come over the next couple of months.
Do we have a recession coming in the next 6, 12 months?
I think right now the trajectory is obviously slowing. What tips us over into recession, I believe, can very well be where the stock market goes, because the consumer is holding us up. The upper-end consumer spends most of the money. If the stock market starts to react to a deterioration in earnings, and that then affects, and then we see a decline, and that affects consumer spending, that could be what tips us over into a recession. But if we do get a recession, I'm only expecting a mild one. Just as the expansion was mild, I expect any recession that we get to be mild as well. But this time around, we're not going to be able to rely on the Fed and rate cuts to somehow regenerate growth, just as we had in the past. Now, they'll try, but I just think we are desensitized to a lower cost of capital, since the cost of capital is already so low.